Stop overpaying for insurance. If you don't know this, you leave your money and potentially your legacy to chance. Don't make these insurance mistakes. Look, people all the time are insuring the inconsequential. It's costing them way too much. You only want to insure the catastrophic. The other thing is, property value is easy to get handled, car, home, but often it's handled at the expense of our human life value. Those are the intangible things that really matter, like protecting from liability, death, disability. Also, a big mistake is people just don't transfer risk and they retain it. They try to save money by doing self-insurance, but what they end up doing is using their assets to insure, which means for every dollar they have set aside, it's costing them at least $1 to insure rather than insuring for pennies on the dollar. Another is not coordinating their policies, therefore paying far too much in premium, or buying on price without the consideration of coverage. Like, if the event were to happen tomorrow, how much insurance would you want today? Probably as much as you can get. It's just we don't want to pay for it. So designing it properly is really important so that we're not overpaying for unnecessary coverage. Or if people just see insurance as an expense, I get it because it's frustrating. I remember my mom once sitting paying bills. She's like, oh, these insurance, we're just getting killed by insurance. I'm like, killed by insurance? What does that mean? It's just that, yeah, she was paying a lot for insurances. And man, I've seen that, especially with health insurance, right? But there's certain ways where protection can become really productive. We'll talk about that. And when a lot of the insurance providers have a lack of understanding, it's like we're working with order takers. They're not actually making sure that we're transferring that risk and properly protecting ourselves. They're just focused on price and price alone. Another major issue is churn. This especially happens in life insurance where people just move from policy to policy and there's a lot of upfront costs, so it ends up costing them in the long run. And then finally, there's a lot of duplicate coverages and improper structures that lead to inefficiency. So here's the ream. Rather than paying claims, maybe insurance companies are just more interested in advertising commercials. Really, insurance companies have the best commercials now. Not beer. Beer companies should have the best ones. They used to. Now it's insurance. It's like all the beer writers had to go to AA, so they switched to insurance. Now, eventually, they'll just get lazy and start reusing old ads, right? What's up? I just saved a bunch of money by switching to Geico. That's what's up. How many insurance commercial jingles and slogans do you know by heart? Let me test you. Geico, 15 minutes can save you 15%. Hopefully you got that one. Look, the last time I got advice from a talking lizard, I was on mushrooms and he told me to buy crypto for some reason, so thanks. Like a good neighbor, State Farm is there, right? If you're a good neighbor, you'd stop interrupting my TV programming so I could just watch the damn football game. You're in good hands with Allstate. Yeah, you know those hands, the ones grabbing the money from your wallet. Nationwide is on your side, right? Great, I'll call you the next time I lose another argument with my wife. Farmers realized how stupid this was. They were like, we are farmers. Dum-da-dum-dum-dum-dum-dum. Yes, it is dumb. And Liberty didn't even try. They were just like, liberty, 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 liberty. Yeah, just say the name 4 times. That's fine. I think that's the first time a typo was turned into a slogan. In Beetlejuice, you had to say the name 3 times. Wonder why they chose 4 before an agent showed up at your door. Now think about it. There's all the spokespeople and characters. I mean, really, there's no new spokespeople in other markets. Tony the Tiger, Ronald McDonald. These guys have been around for my whole life. But in the last decade alone, the insurance companies, they've given us Progressive. Well, they've got Flo. Flo, that's what my wife calls her period, so that seems dangerous when she dresses all in white. Oh, don't worry, she probably has insurance for that. And if she's so progressive, why does she look like she just came from a Good Housekeeping article written in the 1950s? Aflac has that annoying duck that just screams, Aflac, because I guess it's kind of like quack. You'd have to be smoking quack to come up with that. I know that was stupid, sorry. Liberty Mutual just saw the Aflac ads and said, oh no, find us a bigger, better bird. One dude was like, well, if you take the first 2 letters of our name, it makes Limu, which rhymes with emu. Great, let's do that. So now they have Limu the emu, who's sometimes a detective, I guess. I can't keep up with all the storylines. And Geico's crazy. They were all like, we need 40 spokespeople, go. Some places started naming off animal things. A camel, but on hump day. A pig that says, wee, all the way home. A gecko, because I guess it's kind of the same word. Brilliant. What else you got? Caveman. I love it. Here's $100 million. Go. How about the general? Go the general, right? Look, you never want to get in an accident, exchange information. Oh, good. You've got the cartoon army guy insurance. I guess they're saving you money by never improving their animation. Now the general has Shaq, who's not helping. I'm not taking advice from Shaquille O'Neal. Shaq, why are you here? Can you even get insured? You're bigger than like 96% of the cars out there. And while auto and home insurance, it's good to have. How many other things do you pay for and hope to never really use? A plunger? Mace? Encyclopedia Britannica? The morning after pill? Floss? Would you like to pay the same yet have better coverage, or pay less for the same coverage? Would you like to know, instead of just hope, that things are covered and mistakes won't cost you? Well, let's look at the top 10 mistakes with insurance. The first mistake is not transferring the risk. If we don't transfer the risk, then it's our assets or our income that's at risk. Up to 50% of our income, as a matter of fact. So just transferring the risk can help us out with peace of mind. Like, some people argued with me once. I said you can either transfer or retain the risk. Someone's like, no, you can avoid it. Okay, how do you avoid the risk? My great-grandma, she was just sitting watching her stories, as she called it, daytime operas, soap operas, crocheting. And this a-hole, Ryan, drove as a drunk asshole during the day into her house, like the front part of her house, and knocked the grandfather clock over on her head. Cracked her head open. Like, she was avoiding risk, but it still happened. The problem is sometimes when we avoid, we actually diminish our ability to produce. It requires too much peace of mind. It creates scarcity. Remember buying my first car. It was an Acura 3.5 RL. As soon as I left the lot, I was like, oh, wait, shit. I don't have coverage. I didn't know that I had 30 days of coverage from the insurance that my mom had bought for the car when I was in college. So the whole time I was driving, I was like, oh, I hope these a-holes, they're going too fast, and I want them to hit me. And I went and parked it in the driveway. My mom's like, hey, come and show us the car you got. I don't have insurance. She's like, you have insurance, you dumbass. It transfers in 30 days to the new car. Oh, okay. Right? So that's part of the problem. The other thing is, if we don't have the right coverage, then it's our money and we have to hire attorneys. If you have the right coverage and transfer risk, it's the company's funds and the attorneys that protect you and help you to protect the people in case you had an accident and harm someone else. The second issue and the second mistake is something people call self-insurance. I'm going to just do a little shameless plug here for Killing Sacred Cows 2.0. There's a chapter in here called self-insurance. It's a pretty awesome, I think it's one of the 3 most revolutionary chapters in here. There's one on called Avoid Debt Like the Plague. That's really important for people to read. And the finite pie. That's the foundational piece in here. But self-insurance, I have this, and by the way, you can just go ahead and put KSC2, if you DM me at Garrett B. Gunderson on Instagram. I'll just give you a PDF. If you want to buy the book, I'll give it for free. You just cover the shipping, and I'll even, for a penny more, give you the audiobook, all right? But I'll hook you up, and you can go right to that chapter. I use this example of homeowners insurance. Imagine that you have $1 million home, no mortgage, so you decide, you know what? I don't have a mortgage. I don't have to have homeowners insurance, so you drop your homeowners insurance. That might save you at most like a couple $1,000s a year. But if you have to lock up that $1 million because your insurance is actually your own money, you can't earn as much interest on that because it might be tied up, might not be as liquid. Do you think you might be able to earn more than $2,000 a year on $1 million? Absolutely, right? So self-insurance means you spend at least $1 for $1 of coverage, at least $1, if not more, because you have the opportunity cost of what you could earn. But if you have homeowners insurance, you pay $2,000 to transfer $1 million of risk. So you don't want to retain risk if it's something that is easy to insure and inexpensive to insure. The third is a lot of people just insure the inconsequential rather than the catastrophic. An example, I've seen so many people have like a $100 deductible. Would you really get an offender better and make a claim? In claims, it's more about the frequency of the claim than it is the size of the claim. So if you make too many claims, they drop you, even if they're small claims. I know someone named Tom. He made 5 insignificant claims, and he got dropped and had to go to specialty insurance, which cost him 10 times more. So insure the catastrophic. Raise your deductibles. Handle the small things on your own. If you have the cash to do it and you can go to sleep that night, that's enough peace of mind. You're okay. Only insure the things that if it would harm your legacy or you destroy your peace of mind, well, you want to insure that. Same with disability insurance. There's elimination periods, 30 days, 90 days, 180 days. The longer you can go, the lower your premium, because there's a much higher likelihood of a short-term disability than a long-term disability. But then you can insure the catastrophic and get full coverage. I know people that have such minimal coverage, if they're disabled, they're actually planning for bankruptcy. You know this, the state minimums on some of the limits of liability for car insurance are $15,000 per car, $30,000 maximum per occurrence. If someone hits me and I can't work, that's not going to go very far. It's now on them. You want to transfer that risk to companies worth billions of dollars. Like, you can use an umbrella policy to cover that. It's an excess liability policy sitting on top of your car and your homeowner's insurance. The fourth mistake with insurance is property value protection without consideration for human life value. Human life value is your liability coverage, disability, health insurance, life insurance. Property value is your cars, homes, things we can touch and they're easier to replace. So what's more important to cover? The ones, we're forced or we're required by law, not everybody does it, to have car insurance. But the reality is, life, we're guaranteed to die sometime. If you use the Rockefeller method, you will get money that comes in at your death, which means you can spend more of your assets knowing they can be replenished or replaced. There's a whole strategy in what would the Rockefellers do. Highly recommend this book. Guess who wrote? Oh, yeah, I wrote it. I recommend this book. It really helps to understand this at a deep level. And again, WWRD, go ahead and put that on Instagram, Garrett B. Gunderson. I'll hook you up, give you the PDF of it. If you want to have a physical copy, again, you cover the shipping, handling. I'll cover the cost of the book. I'll make an investment in you. All right, the fifth mistake is we're going back to car and homeowners insurance. Uninsured and underinsured being lower than bodily injury. Bodily injury is you hit someone else and whatever damage you cause there. Uninsured, underinsured is some other driver hits you. They don't have coverage or they barely have any, like that state minimum. Your insurance company kicks in and covers you. Like, this is crazy. My mom got hit by an Allstate agent. Allstate, not in good hands, because he had state minimums. It wasn't enough to cover everything. But my mom's policy kicked in and covered where his was deficient. I know you'll be surprised, but over half of the accidents come from people that are uninsured or underinsured. So you want to be really careful with that. The sixth mistake is not coordinating policies. I remember, I won't say her name, but there was a woman out of Texas, and she had like Progressive and Allstate. I'm like, why don't we just pick one company? And by picking one company and raising her deductibles and adding umbrella policy, it was $700 less per year in premiums with $1 million more of coverage. Now, what did that cost her? $900 of exposure, because she went from $100 deductible to $1,000. But she got $900,000 more of coverage in liability, and she ended up saving $700, which meant it was just over a year that she covered however much she would have lost in deductible if she had an accident. All right, so the seventh issue here is we're trained to kind of see this as an expense. Look, nobody hates insurance. We just hate paying for insurance. So if you look at it just as an expense, that's a problem. Now, most people think of expenses as negative, as something to minimize, but they can minimize their wealth with that thought process of reductionist thinking. There's 4 types of expenses. One is the destructive expense. Get rid of those destructive expenses, borrowing to consume, things that you're paying for and never utilizing. Eliminate those. Lifestyle expenses, pay cash for those. That's clothes, utilities, housing, all that kind of stuff. Protective expenses are neglected for the middle class, and this is why we hear all the time, oh, people aren't saving enough money. A lot of people are saving enough money, but they haven't actually transferred risks, so they're one financial surprise away from having their wealth confiscated. So a protective expense is everything from savings and education to insurances to asset and legacy protection planning. These are the things that are critical that if you do the right things, you'll keep a lot more of your money. So that's how a protective expense becomes more productive, because it preserves your assets. The eighth thing is, this mistake is just a lack of philosophy and understanding. Just leaving it to order takers. I had my buddy, his name's Darren Miller. I think he started at State Farm when he was 9 years old, licking stamps for his dad's agency. And then, when I met him, he told me he bled State Farm blood. I'm like, what in the hell do you mean you bleed? Like, he was so indoctrinated. I'm like, are they always the best? He's like, no. I'm like, why wouldn't you want to be an independent where you could write with any company versus being relegated just to one? to his credit, he left a book of business with this renewal base to become an independent agent because he was tired of just being in the order taker system. He's a nerd for this. He just gets at a deep level. And so I had him at an event, and he spoke for an hour. Yeah, we had an event, and he spoke for an hour on insurance. But at least after that 1 hour, everyone in that room knew what to do. And he said, here's the major mistakes. And he said, all right, someone give me their agent's number. And someone gave their agent's number. We called on speakerphone. It was in an auditorium. It was like 85 people there. And that person called and made 11 mistakes in quoting a policy, not considering deductibles, not considering limits of liability, not talking about an umbrella policy, not having replacement coverage on the homeowner's insurance, these basic things that he went through because all they were trying to do was beat the price, not looking at the coverage. Another issue is churn. Churn is someone buys an insurance plan, someone else comes and says, no, this one's better. And especially with life insurance, they have all the commissions and costs up front and they roll over to another policy. And now they have a setback because of that. So having a philosophy is important. Understanding what's going on and then having an agent that's passionate about what they do and that's actually a strategist helping you design it properly. You know, Darren's been my guy for a long time. And I remember we had an issue with our roof and they only wanted to cover part of it. And he said, no, based upon this part of the policy, it is covered, and I got the whole roof replaced. I had another client that had a $400,000 out-of-pocket issue, but they had a business owner policy. And I said, your business owner policy should probably cover it. It was with Hartford. And I don't think it does. We called our agent. He said it doesn't. I said, well, let's call Darren. Darren knew to go to which page, which provision. He said, no, that's actually covered. Now they had to go back to try to get the $400,000, but then just have an agent that knows what's going on to get it from the first place, right? That's really key. All right, the 10th thing is a lot of people just have duplicate coverages. They have bad coverage or improper structure. So here's an example. Let's say you do get this umbrella policy, also known as an excess liability policy that sits on top of the car and homeowners. And if you have higher than required underlying limits, and then add an umbrella, you have a duplicate coverage. The umbrella might say you need a $100,000 limit on your car and home, and then the umbrella policy kicks in. So if you have a $500,000 on the car and home, you actually have $400,000 of no insurance because it's actually covered by the umbrella. They don't give you both. Another issue might be, here's a bad coverage. Having actual value rather than replacement value with your home. So replacement value would say, like, I have a TV in my cabin right now. I mean, it's probably worth $5. It's not worth anything, especially, there's all these really nice new TVs. So they might give me a few bucks if it got stolen or if there was a fire or there were damage. Replacement says they're going to give me the newest one for full replacement value. So that's an example of a bad coverage. So look, I get it. We don't wake up in the morning and go, you know what? I'm going to think about insurance. And so we end up with stale policies that don't do the job they were meant to do. We have exposure, and that exposure, when the incident occurs, becomes our problem. I want attorneys on the hook with these insurance companies, transferring catastrophic risk because the first dollar we pay for insurance is the most expensive. The last dollar is the least. So our deductibles have a lot of influence over our premium. But our limits of liability have less financial impact to our dollar, but more impact if the incident actually occurs. I always try to think of it that way. If the incident were to happen tomorrow, what kind of coverage would I have today? The best thing to do is if we could buy insurance after the incident. Get in a car accident, we know exactly how much to buy. But because you can only buy insurance when you don't need it. What do I mean by that? Like if you want life insurance, you can't be deathly ill. You have to get it while you're healthy. So we have to do the best we can by designing it properly. I don't want to have people pay unnecessary amounts of money to get the coverage. I just want it that if something happens, the coverage will do what it's meant to do. Insurance kind of gets a bad rap, and deservedly so in most cases, because it feels like we buy disability insurance and they try to wiggle out and not pay. What it says in the contract matters. In disability insurance, for example, if you have own occupation versus any occupation, if you can't do the work that you do today and there's an incident, and you're disabled for that, but you could do something else, they still pay you based upon your occupation. Any occupation says, no, you can go work at McDonald's, so we're just going to, we're not going to pay you anymore. You want own occupation. That's an example of having the right contract and the right coverage. If you're too focused on price and not enough on value and protection, you leave yourself exposed. I feel like these insurance companies, we joked about it right at the beginning, they have so many damn commercials, not enough emphasis on policy design and payouts. I'm with insurance companies that don't advertise. Far too many of the ones that advertise, I feel like they try to wiggle out. They try to have too many provisions that are disclaimers or that don't cover the person. And the other thing is, I don't want you to have order takers. I want you to have strategists. I want you to know that you've done this right. You're paying the money. I want to make sure you have the right coverage. So the question is, what would money Jesus do? What would money Jesus do? Now, look, I don't even really look like Jesus because I'm too old. I have too much gray. I used to get people all the time at events, oh, money Jesus come up to speak. Yeah, okay, cool, flattering, true. But I guess I had stress that Jesus didn't have. I got married, I had kids, So he died a lot earlier, like 30, at 33, I'm 46, so 13 years later here. But what would he do? Raise deductibles. He'd make sure I have the coverage that if an incident happened that was an accident, that it indemnified and took care of the other person. So you could raise deductibles, increase elimination periods, and maximize your coverage. Get as much uninsured, underinsured as possible with bodily injury. Protect your full economic value and the human life value factors. What's economic value? Like with my life insurance, if I die, I want a replacement of the economic value. I want my family to live the same lifestyle. I asked someone once, I said, if something happened to you, would you want your spouse to live the same lifestyle, a better lifestyle, or a worse lifestyle? He's like, definitely worse. And I thought he was joking. He was serious. Didn't become a client, actually. Because I said, well, why would you say that? He goes, well, she could always move in with her parents. I'm like, maybe she should do that now, right? I mean, now I don't want my family to have an incentive for me to die necessarily. I'm talking about just replacing income. Like if someone made $200,000 a year and they're like, ooh, $2 million sounds like a lot of life insurance. Well, is $2 million a lot if you could never earn another dollar? No, it probably doesn't sound like that much money anymore, right? So you have to kind of think in that way. Look at the value factors, the human life value factors. How do you protect you and your family? Because you're 4 times more likely to become disabled than to die prematurely. So disability from insurance is like a living death and making sure that's taken care of. Any amount of disability insurance you don't have, the difference between what you could have had is your deductible. And that might be millions of dollars over your lifetime if you become disabled. Focus on ensuring the catastrophic, not the inconsequential, so you're getting the most bang for your buck. And then take an inventory of your home. You have homeowners or renters insurance, go through, just take pictures, take video, and upload it to the cloud so that if anything happens, you've got proof of what you had. Now, I had a video guy that heard me talk about this as an event. And so he went home and just videoed everything he had and, stored it. Now, that apartment complex years later burned down. And he called me and he's like, dude, I'm so thankful that I listened to what you said because I talked to some of my neighbors. They still haven't got their money back. He goes, I got my money first, and I got a lot of money because I had proof of everything that I had. So, again, use companies that don't advertise. I think about, I had this really wealthy couple, and when I looked through their insurances, it just didn't have great design. One, I argued that a lot of the additional provisions to protect, gold and jewelry seemed a little high. They had low deductibles, so we raised it all the way up to $2,500 because they had plenty of money. And we had an umbrella policy. Now, we saved them $253 for the year. Not a big number because they went from $500 deductible to $2,000. So that's, $2,000 of additional kind of they have to take care of themselves. But we got them $9 million more of liability coverage. So they saved $250, but they got $9 million more of coverage. And if they would have made more than one claim on their home, they're probably going to get a raised premium anyway. So I just want them to be more intelligent about it. So hopefully this helps you to avoid the missteps when it comes to insurance. We're all paying for it. Make sure the company is on the hook to pay and not you.